Good morning. It's Friday the 30th. Here's what's on the agenda. Is Warsh heading back to the Fed? Markets start to price that as an outcome. And the tech spotlight falls on Apple.
European futures point higher, gains of 0.4% after a tech-led sell-off across the European session yesterday. But here is the focus. It is dollar strength. The greenback is back, up 0.4% on the Fed speculation and expectations around Kevin Warsh. Gold taking a hit, down 4.4%, but still up around 18% year to date. The countdown to the opening trade starts right now.
What day will you be announcing your Fed chair pick next week?
Tomorrow morning.
Tomorrow morning.
Oh.
It's going to be a massive day. It is really exciting. We are trying to figure out whether it is going to be Warsh. It looks like it's going to be Kevin. We need to talk about Kevin. What would Kevin Warsh bring to the Fed? It is something to really think about, and you can see it rippling through asset classes already this morning. Kevin Warsh is not a clear dove. He has been highly critical of the Fed and its miss of the inflation surge post-pandemic. He is not a fan of QE. He is not a fan of the Fed intervening into the markets. He is not a fan of the sport blanket that the Fed has provided to equities and other asset classes over the last few years. Why is Trump going to pick him? And is he a guy that can change his spots? Because all of those things have been true of Kevin Warsh in the past.
Yes.
Are they true in the future?
Our thinking had been President Trump wants to pick someone really dovish, and Kevin Warsh doesn't, according to what he said in the past, doesn't necessarily fit the bill. Although a lot of the things he said in the past come from his time at the Fed, and that was a pretty exceptional period, wasn't it, around the GFC? And it was quite a long time ago now. So now we're all going to be looking for clues as to how up to date this thinking is. But there is this sense that maybe he is hawkish. But how smooth is his any approval process for any Fed chair, given what we've heard from some of the senators, Tom Tillis?
Yeah, that's going to be absolutely crucial. It was about two Kevins, Kevin Warsh and Kevin Hassett. It's still about two Kevins. It's the Kevin of the past, Kevin Warsh of the past, and the Kevin of the now. Yeah. And it's which one do we decide is going to be taking the lead when it comes to that Fed chair role, if indeed Kevin Warsh does get that nomination. To your point, absolutely crucial that key Republican on the banking committee, Tom Tillis, has said he will not approve these nominations until the DOJ stops their investigations of both Powell and the Fed. So that remains a key question in terms of the time frame. When do you get Warsh into that seat, if it is him?
Yeah.
But what does he do when he gets there?
Yeah.
He's going to get there at some point, right? They're going to figure out how to make this work, and they will figure out a way of getting him to be, because I don't know what happens in the interim, because actually Powell has to step down. So there's a kind of there could be a weird interim period coming up when we have to kind of think about vice chairs and all kinds of other things. But let's park that thought to one side for the moment. Even in 2025, Hassett was talking about the fact that he didn't like QE, that he's talked quite aggressively about the fact that he doesn't like the distortions that the Fed has caused in the markets.
Kevin Warsh,
Did I say Hassett?
You did.
Okay. I meant Warsh. You've got me thinking about. But he's talked to so this whole idea that equities can't go down, that they will be supported by a Fed that will come in and deliver QE, the power of QE. Is that still there? Is that safety blanket still there for markets?
And let's see whether we do get confirmation that it is the person that the markets are now really pricing in and thinking it is, just because I refer you to the comments by the President about yo-yos, and certainly lots of assets are yo-yoing around right now, as it is absolutely the truth that he can send them in all kinds of directions. Let's talk about those yo-yoing assets, shall we? And I wonder how we characterise what we're seeing in markets. Is this... I've seen it described as risk-off in relation to Kevin Warsh being hawkish. But is it all risk-off? I don't know. I don't even know what risk-off assets look like anymore. Everything has been thrown up in the air, hasn't it? I mean, that would suggest that the dollar is a haven again. It would suggest that gold is not a haven. Is this just a reaction to the dollar? Is that what we're seeing?
It feels like this is just the dollar. This is the change in the dollar. And then you have to reprice everything else off the back of that. I am stunned that European equities are holding in there this morning. US equities are getting hit quite hard this morning. Like Nasdaq futures are down circa 1%. S&P futures are down by 7/10 of 1%. European futures are still positive. Does that change in the next 55 minutes?
How sustainable is that? The yield curve, really interesting as well, in terms of the steepening at the long end when it comes to US Treasuries. The yield's up 5 basis points versus flat on the 2-year as well. So that's pretty pronounced on the Warsh expectations. We're also, of course, focused... The big losses that came through for Europe yesterday, maybe that's part of the catch-up in the future today, is that there were heavy losses, more than 3% when it came to tech. Apple, of course, coming through with earnings, and Microsoft absolutely hammered in the session yesterday. The biggest drop that we've seen since Nvidia across markets historically in terms of what came through for Microsoft. But we'll start with Apple, which is that they came through with a very solid beat over the Christmas period. It was a record number for them, and the forecast for the current quarter stronger as well than expected. But interestingly, and this is something we've been talking about, which is costs, and they flagged this, potentially squeezing of margins. Tim Cook mentioned this because of higher memory costs, higher chip costs, and that ties us back to the inflation story.
And this is something in their outlook, isn't it? This isn't looking back. Looking back, that margin story, that cost story was OK. This is looking forward. It's something that the market will have to price in. On the upside, though, of course, there was the strength in EM, India and China doing well for them, it would seem. But to your point about the the Microsoft move yesterday was incredible. The second biggest drop in market cap that we've got for that stock. So that is an incredible verdict on the results that they put out, and it only pales in the face of the verdict around SAP. I mean, that was incredible as well. That stock down by 16% by the close here in Europe.
Will we look back on yesterday as being kind of one of those moments where you go, the AI story is beginning to be seriously questioned here, and what happens with it going forward, the differentiation between different stocks? It's kind of yesterday really felt like that was the day in which it started to become really clear. We've talked about sort of hardware versus software, but yesterday it was just crystallised.
And we talked about SAP. I mean, more than the market cap of SAP entirely wiped off Microsoft yesterday, like $360 billion US, close to $360 billion, because for the critics, the skeptics, and the bears, they are not getting the return on investment from that capex spend. And this is further evidence of that in terms of the slowdown in growth for the cloud, and they were punished for that. To your point.
And that wider point about whether this is a turning point, who's going to be, if it is, then those who believe in AI replacing some of this software are on the right side of the argument. But it could be that there is a fight back from the software players, and maybe Christian Klein and co are right, that actually you can't just have AI, you need their products in the mix as well, and that's the argument he's making, and that's why some see it as oversold.
But tie these two stories together, okay? Kevin Warsh and what you're seeing, what you saw yesterday in terms of the stock market. If that continued, will the Fed be there to support markets? How critical are the financial markets, are equity prices to the strength of the US economy?
Well, Markets Live making the point that he was quite tolerant of market volatility when he was at the Fed. And there was a lot of it at the period that he was at the Fed.
So maybe he will accept a wider bandwidth, a sort of amplitude in terms of what markets do before stepping in. And he has been critical of QE. He thinks it's distorting. He doesn't like the effect it has in terms of financial markets and the real economy.
OK, lots to talk about this morning. It's Friday. It doesn't feel like the week is over. That is for sure. Let's tell you what's coming up on the programme. First, we'll get a roundup of some of our earnings interviews, or we'll round off our earnings interviews, with Gonzalo Gortazar from CaixaBank, the CEO there. We will talk about the banking sector and his plans for that Spanish lender. Dorian Carrell will be joining us. Schroders multi-asset investment head, Maria Minucci, M&G multi-asset fund manager, and Tulan Nguyen, Commerzbank's FX and commodity research head. So plenty of different assets in focus when it comes to thinking about how Warsh at the Fed would play out for markets. We'll also be joined by Johannes Reck, GetYourGuide Deutschland's CEO. So we turn our attention to a travel and leisure and tech conversation a little bit later in the programme. It is Friday, Tom, and we all need that.
We do, indeed. We'll get some travel tips maybe at the end of the show. Here's what else to think about today. Prime Minister Keir Starmer has been travelling to China, and UK citizens will be able to travel there without visas as well. That's part of the deal that's come through. So no visa requirements for UK citizens travelling to China if they want a holiday there. Starmer speaking at the China Business Forum later today. And from 9 a.m, we're going to get Euro area GDP from Italy and Germany. 1 p.m, we're going to get German inflation as well. US earnings on the docket today is the big oil majors, Exxon, Chevron, and American Express in the financial services space. And there is the deadline for the US government shutdown. They are appearing to make some progress towards a deal, but it doesn't mean that a shutdown is not going to happen, at least for a couple of days. 1:30 p.m. UK time, producer prices out of the US. And we're going to be hearing from the Fed's Musalam and Michelle Bowman as well. So some Fed speak on a day when we're expecting, of course, the President to announce Kevin Warsh potentially as the next Fed chair.
Trump's not that happy about Starmer in China. He's more unhappy with Carney, it feels, than he is with Starmer.
Relative, isn't it? There's a sort of gauge of how much you have upset the US president, and when he says, yes, I'm cross with you, but I'm more cross with this other person.
You take that as a win?
I mean, maybe.
Feels like it.
Yeah.
Yeah, he quickly moved on, didn't he? Because the question was, what do you say to the Brits? How do you think about Prime Minister Keir Starmer in China? He said, not great, and quickly moved on to Canada. I mean, the irony is that President Trump's going to China in the next few months, and presumably he's going to be striking his own deals with
and we're not
China.
talking all singing, all dancing, covers everything trade agreements between China and Canada or China and the UK. We're talking about small baby steps towards something a little more civil in the relationship.
Will Starmer consider that a win? Has he got away with it? I think probably it feels like he has. I don't know. Maybe you get more. It's so difficult to judge these things. Let's talk about what else you need to know this Friday morning. President Trump and Senate Democrats have reached a tentative deal to avert a disruptive US government shutdown. However, the White House continues to negotiate over placing new limits on immigration raids that have provoked a national outcry. Lawmakers almost therefore won't enact that measure before a Friday night deadline, meaning a partial government shutdown actually in reality could still be the most likely scenario. Bloomberg has learnt that US law enforcement has been investigating allegations made by former Meta contractors that suggest that the company's personnel can access WhatsApp messages. We're told the claims have been examined by Commerce Department agents and separately in a whistleblower complaint to the SEC. Meta markets the app as having end-to-end encryption, and a company spokesperson says the contractor's claims are, quote, impossible. And Tesla shares rose in extended trading after Bloomberg reported that SpaceX is considering a potential merger with the EV giant, as well as an alternative combination with XAI. Sources say that any transaction could attract interest from infrastructure funds and Middle East sovereign investors and may require a large financing component. The move signals billionaire Elon Musk's efforts to consolidate his empire. What do we think about this?
He's so uninterested in cars now, Elon Musk. That's what I think.
Such retro technology.
He's obsessed with humanoid robots. He's obsessed with SpaceX. He's obsessed with XAI, and that is where his focus is. And so how do you think about that as an investor and a shareholder in Tesla?
So Tesla just becomes a robot company?
Maybe. Space exploration, robot company. The stock went up yesterday, which wasn't necessarily a given. I mean, there's a lot of enthusiasm for anything Musk touches amongst the shareholder base, I suppose, of Tesla. So maybe
and they're a slightly different breed, the shareholder base.
Trying to understand the reaction function of in Tesla shares to what Musk says is quite difficult, I think.
All of this scene is still coming before, I was going to say before an IPO. Obviously, if it's a combination of Tesla and SpaceX, then you maybe don't need an IPO because Tesla's already listed.
Yeah.
But SpaceX is planning an IPO, so that around his birthday, we were discussing with Craig.
Yeah, when the stars align.
So it all just come together under one, though. Does it just become one company? Is that kind of ultimately the direction of travel?
Well, the reporting suggests there's a choice between Tesla and SpaceX or SpaceX and XAI.
But does that preclude kind of a two-step process?
Yeah,
it doesn't feel like it does.
And there's potential governance issues when you have those kind of combinations. Yeah. And then question marks about his compensation as well, which of course he struggled to get through previously through the courts and across the board. So
does Tesla remain?
This is a company that is being reformed by the minute, it seems. It's a collection of businesses.
Maybe maybe Elon Musk wants an easier life. Put them all together. Maybe that gives him an easier life. Coming up on the programme, Swatch reports a big miss on operating profits, but expects substantial growth in 2026. We will check in on that stock when it's time for the European market open. Plus, Adidas is called higher after announcing a beat and a buyback. That news coming after hours yesterday and sneaking into our news flow this morning. Up next, Spain's CaixaBank raises its targets over the next 2 years. We'll be speaking to the CEO. Just how buoyant is the Spanish economy and how excited about the future is Gonzalo Cortazar. If you have any questions, if you want to get involved in these conversations, IB plus BBTV Go. That is the function to use this Friday morning on your Bloomberg terminal. This is Bloomberg.
when you look back into all technological innovations which happened over the last 10 years, it always started on the hardware side of the house.
Memory constraints have been talked about a lot over the last few weeks, but there's also, there's been other constraints, not just, energy, connectivity. This is also going to be a much longer and more stable growth trajectory for the industry.
I say it again, like we have said in the last 2 years, AI is big, and this is about product, this is about infrastructure, this is about investment that will revolutionize basically society for many, many years to come.
Okay, CEOs talking to us about how they see AI impacting their businesses and society, of course, going forward. And we've seen a mixed reaction in terms of investor responses. And we saw Microsoft under the hammer, of course, or hammered yesterday in the session on concerns about their spend on AI infrastructure. European futures today, after feeling the pressure from the tech trade yesterday, that sector dropped around 3%, SAP tumbling in the session yesterday. Today, European futures are actually pointing to a robust session on Friday, despite as well the announcements or the expected announcement around Kevin Warsh to the Fed, up 0.5% across the benchmark. The FTSE 100 currently flat. Obviously, copper prices, oil prices, and metals, precious metals also down. So that could be a weight on the FTSE 100. DAX futures pointing to gains of 0.5%. Some good news coming through for Adidas, and the CAC current over in France pointing to gains of 26 points.
Get a bounce back in SAP today. Is that what we're seeing in Germany? Anna was pointing that out earlier. Okay, let's talk about what's happening in the banking sector. Let's go to Spain. CaixaBank out with its numbers this morning. The numbers have beaten, and the company has raised its 2025 to 2027 target. Return on tangible equity now circa 20%. Maybe a bit north of 20%. The company's CEO is Gonzalo Gulthazar, and he joins us now. Great to see you, Gonzalo. Thank you very much, as ever, for your time. You've raised your targets. What gets you to these raised targets?
Well, it's a very robust Spanish economy, a Spanish and Portuguese economy, where we have most of our operations. And on the back of that, we have posted very strong volume growth, 7%, both customer funds and in lending. Economy keeps looking pretty good. And hence, the profitability that we already have is likely to increase from the 18% level to the 20%.
Okay. Can I infer from this that we're going to see higher dividends? Should shareholders be expecting higher returns from the bank? Or does the money get used elsewhere? Does it get used in investment? Does it get used in taking market share? What are the plans that this extra flexibility gives you going to be?
Well, I think we are in a position to target all of the above, as you said. So profitability is leading to higher dividends. This year, we're increasing the proposed dividend by 15%, dividend per share. We're going to keep buying back shares as we generate further capital. But at the same time, we're gaining market share across the board: insurance, banking, deposits, lending. Clearly, this year, we've gained almost 400,000 new clients this year. And we're certainly investing a lot because, obviously, transformation of the business is needed on the back of the technological development. So I think at this stage, because we're very profitable, have a strong competitive position, we can do all three: is grow, invest for the future, and continue increasing the shareholder remuneration. Yes.
Gonzalo, good morning to you. You've already mentioned the strength of the Spanish economy, so I'll get some more detail from you on that. The Spanish economy, one of the fastest growing in Europe, of course, last year. What do you see for the outlook in the data, or how does it feel to you operating in the Spanish economy? Does it feel as if that buoyancy continues? It feels that way. Actually, in a few hours, we will be knowing what the GDP growth for 2025 has been. Expect around 2.93%. When we look into next year, and based on the current indicators that we're seeing, I think we may have a slowdown, but only towards the 2.5% area. We'll see, depending on the figures of the fourth quarter. That'll be an important data point. But it feels good. Asset quality is improving month after month. Consumer spending, which we track because we have a 30% market share in payments in Spain, is actually growing very nicely and steadily. And I don't see at this stage sort of clouds in the horizon. Obviously, we have an interdependence with geopolitics and global events, and that's something to watch for. But from the Spanish point of view, things are looking well. Okay, so clear skies for the moment. Does that sound like an environment that encourages more M&A, Gonzalo, either domestically or cross-border? I mean, both seem to have been difficult to do in Spain.
I'm not sure that it does necessarily. I think in the Spanish banking environment, everybody feels pretty good because they are having higher profits and clear sky. So that obviously isn't sometimes results in less action. But I think over the mid and long term, consolidation will continue in Spain and obviously within the Eurozone, and that's something to watch for.
Are there any targets on the horizon for you, Gonzalo? I mean, you say it's more of a medium-term story, but what would make sense in terms of a potential fit for CaixaBank when it comes to the consolidation story?
Well, fortunately, Tom, we've done our homework. We now have the largest bank in Spain by far, with over 25% market share, and a very strong position in Portugal, growing, profitable. This concentration of our two economies is working well. We have a wholesale presence in the Eurozone with over 30 billion of exposure there, but limited to the wholesale area, and the plan is to keep going that way. We don't see value creation in moving cross-border beyond the two big countries in which we are.
What are your priorities for the wealth part of the business, Gonzalo, particularly when you push internationally? Some of your competitors, I'm thinking Santander in particular, and others expanding their footprint, for example, in Florida, in Miami. Is that something you may look to do as well?
Well, we have a very good and leading presence in Spain. We've expanded into Luxembourg to provide another jurisdiction for our clients. We continue to be focused on clients from Spain and Portugal mostly, but obviously now we're receiving a very significant influx of people from Latin America in Spain, and that is leading us to think whether we should develop a presence in, as you say, Miami. That's something that we have under consideration. In any case, it would be an investment that just is looking to help and sustain our mainstream strategy, which is in Europe.
Gonzalo, is the US markets becoming less attractive? I hear what you're saying about the fact that there has been clearly a shift in terms of your desire to look at Miami. But what we are hearing is that America is a place that people want to do less business in, not more business in. Do you feel that in any way at this point in time? Is America still as attractive a market as it was 18 months ago?
Well, I would say America is a very attractive market. We, I think, see our clients concerned about which direction things are taking, and that adds some uncertainty. That's never good. But America is America. It's always going to be a very attractive market, at least for the next few decades, I'm afraid. And not people like us. Retail banking doesn't travel certainly transatlantic that well. But for many other businesses, is a key part of the strategy of corporations, and will stay that way, I'm convinced.
Gonzalo, thank you very much. Thank you for your time. Gonzalo Gortazar, the CEO of CaixaBank. Just as we heard in Davos, actually, then, it seems, CEOs can take on board all of the geopolitical tension and still come to the conclusion that this is a very exciting market that they want to be a part of, with all the caveats that maybe go alongside that.
Fiscal spending, deregulation push in the US. It's hard to ignore if you're in the world of finance and banking. And this is a stock just domestically, internationally exposed, but just worth reminding that the CaixaBank stock is up 90%. So it's just another one of those outperformers in the European banking space. And as you described for us, 2026 looks still very strong for them.
Europe, the banking story has been one of the key kind of pillars on which this European equity market rally has been built. And all of the banking CEOs we're talking to still, we talked to Lloyds yesterday, still a really positive picture.
Yeah, no
clouds.
No clouds, clear skies seems to be the message for now. Coming up on the programme, the US president is set to announce his nominee for Fed chair this morning in the United States. From the finalists, one man may tick many of Trump's boxes. More on our market-moving scoop that is coming up next. This is Bloomberg.
Good morning. 30 minutes to go until the start of equity trading here in Europe, cash equity trading. US futures are sharply lower. NASDAQ futures in particular are down by 0.9%. Does that point us to tech weakness, or is this Warsh related? I don't know, but the S&P is down by 0.7%. How does that translate into Europe? I'm not sure it does this morning. Look at what is happening across Europe, and I think you get some quite interesting reads. Euro Stoxx 50 futures are up by 0.5%. Now, the two other verticals there don't really tell the story. FTSE futures and CAC futures are quite quiet this morning. But if you take a look at what is happening with the DAX futures, they are strongly to the upside. And also IBEX futures are also quite strong as well this morning. Those two markets seem to be leading.
Yeah, absolutely. So we'll certainly watch for that divergence then at the start of the European trading day within Europe, and then possibly with the US story as well. Let's have a look at the bond markets. There's not a huge amount to say about the European bond market story. Maybe they just got the popcorn this morning and watching what's going on stateside a little bit later. Maybe the action in Treasuries, because there we are seeing, of course, Treasury yields rising on expectations that Kevin Warsh could be the next Fed chair. We will see where that takes us, Tom.
Well, Bloomberg does understand then that the Trump administration is preparing for the president to nominate Kevin Warsh to be the next Fed chair. Trump said he plans to announce his pick this Friday morning.
Well, you have other political people in the Fed. Absolutely. You have political people that will vote against Trump or a Republican, but in particular Trump. But we've done so well with the economy. You see the numbers. We're getting the best numbers that we've ever had as a country, and that's despite the fighting. We've broken the Fed wall. I mean, they could have been much better. It could have been much more helpful to the country. But even despite the little bit higher interest rates, you notice that the interest rates now are falling despite the Fed.
Well, let's bring in Bloomberg's senior editor, Alistair Bull. Alistair, why Kevin Warsh?
Good morning. Well, critics will say he's been auditioning for this job for the last 8 years, and will probably also point to his connections through marriage to the Estee Lauder family, who are said to be close to Trump. But I mean, to be honest, he's credentialed. He served on the Fed as a governor for 5 years, and in some respects, he's got a somewhat similar background to current Fed Chair Jerome Powell. He's a trained lawyer. He worked on Wall Street. He's a financier. And I mean, so this pick is first of all, it's not a surprise. He was always the front runner. And secondly, he's somebody who comes from the background of a sort of person who has succeeded in this role before.
Alistair, good morning to you. What do you make of the market reaction then here? Because everyone's been busy going back to the GFC and looking at all the things that Warsh said when he was at the Fed last time and drawing their conclusions about how hawkish he might be, what he might think about quantitative easing, for example, and then seemingly repricing things on the back of that. What do you make of that market response?
Well, there's a lot of news to go around this morning, but to the extent this is down to Kevin Warsh, it's going to be reflecting on his long record of being more concerned about inflation than unemployment, and his long record of being worried about the size of the Fed's balance sheet, which he has argued, and a lot of people agree with him, that he has argued puts too much of the Fed in the market, has a distorting effect on the pricing mechanism, and that is going to be bearish for bonds if he does get nominated and confirmed and then follows through. Well, let's not forget, he's just one vote on a committee of 19 people. So if he is chair, he has to navigate and negotiate all of this. I mean, the market's reaction it may come out in the wash, I think, as they get to know him better.
How are we feeling about confirmation? How's it going to work? Is it going to work?
So, I mean, they only have the votes on the Senate Banking Committee if they resolve the outstanding issue around the DOJ, the Department of Justice's subpoenas of Fed Chair Powell, and the ongoing investigation around the Fed building renovation, and also the outstanding issue around Governor Lisa Kirkwood before the Supreme Court. So you've got a key Republican on the Senate Banking Committee, Tom Tillis from North Carolina, who has said that he is not going to advance any Fed pick, including the pick for chair, until the DOJ case around Jerome Powell is resolved, either dropped or adjudicated. So until that shoe drops, the president can nominate Kevin Warsh, but it's likely to get stuck in Senate banking.
Alistair, thank you very much. Bloomberg Senior Editor Alistair Ball, thank you for the analysis. Joining us now with a little more on this story and other thoughts on the markets, Dorian Carell, Head of Multi-Asset Income Fund at Schroders. Dorian, nice to speak to you. Thanks for being with us this Friday. So we thought we'd have a quiet Friday, not such a quiet Friday, because we have this expectation that we get an announcement around the Fed chair from President Trump. Looks like it'll be Kevin Warsh. That's how markets seem to be responding to our reporting. What difference would it make to you and your outlook for this year if we get that news today?
Well, good morning. Like you, I was expecting a very quiet, sleepy Friday morning and being shocked into life at 6 o'clock in the morning. So I think, we were expecting Rick Reeder last night. Now we're expecting Kevin Warsh, and the market started to price it in. You talk about the bond price movements. I mean, they're not that severe, and the futures, it's around 1%. It's not a heavy move. From what we can see, he is concerned about inflation relative to the other candidates, but clearly he has persuaded the current administration, who do want to cut rates, that, he is kind of somewhere in that ballpark as well. So coming out in the wash, we do think that's one of the things. Secondly, Trump said in the video you just had there, breaking the Fed wall, which I thought was a really interesting comment. So, the chair of the Fed is one component of this. There's a court case, there's the composition of the Fed. So when you look at it all together, the price, rate cuts being priced in is about 2. For the next 12 months still. Yield curves haven't moved that much. But things like crypto, some of the more sort of liquidity-driven parts of the market, that's where you might start to think about how you put things together today.
OK. So, I mean, one of the things we are trying to establish, I suppose, is how tough he wants to be on inflation. He would be on inflation. And everyone's going back to what he said when he was at the Fed last time to try and work that out. But that's the most important thing, isn't it, to find out is, how much of a North Star, given it's a central bank with a dual mandate, how much of an inflation fighter do we think he will be?
Yeah, I mean, before this, we were taking the view that Australia, Canada, Europe, Japan had orthodox policies on inflation. The US was moving a bit in another direction. Kevin Warsh has slightly upended that argument, we have to admit that. But when we think about it, the market's still expecting 2 rate cuts. The Atlanta Fed is over 4%. You've nearly got full employment. There's a huge amount of fiscal stimulus, more to come ahead of the midterms. So, the fact the market's still pricing rate cuts, even with this appointment pretty much nailed on, according to the odds, is really interesting for us. So, we think you can take that too far. That was 2009. There was a financial crisis. A lot of time has passed since. And the question really is more about, what people think inflation should be. And, is it 2%? Because the Fed's missed that target for many, many years now.
Where does this all leave the dollar debasement trade?
Yeah, I mean, in the very near term, that could come under pressure. So you could have a stronger dollar as a bit of a reaction relative to expectations. But we still think that real rates in the States, if there are these rate cuts with inflation around 3%, are almost zero. And at the same time, you've got a lot of stimulus and policy making that's somewhat unpredictable. So we would say, strategically it's there. Tactically, you need to be a bit careful.
So you would fade the rally that we're seeing in the dollar right now?
Yes, we think it's good for broadening out. Still, we think that this is reassuring for markets, a very credible candidate for the Fed. But the policies are all still in place. The labour market is still very tight. The tariff policies are still there. The fiscal stimulus is still there. The midterms is a big incentive to keep the economy hot. And then finally, housing market. That's really where they're aiming here. So MBS have been bought. The 401ks, for example, can now invest in mortgages, perhaps. So there's an awful lot going on to drive down the cost of housing, drive up the cost of consumption. Our rates really where they should be with a 12-month view. We would say they're fairly dovish. So, dollar debasement probably sticks strategically.
Can I take us back to yesterday and the big move we saw in equity markets around tech?
Yeah.
And kind of overlap it with the Warsh story.
Yes.
Warsh has in the past indicated that he thinks the Fed has been in the market too much. He has just created distortions, QE, various other factors. He's been too supportive of risk assets.
Yeah.
If you take that support away, what happens if we see wobbles in equity markets? Would it be, because there's this argument that goes around that there will be no tolerance for a drop in equities and the authorities will step in and support it. Do I have to therefore assume that the amplitude is now greater, that the Fed will tolerate more volatility before it makes a move?
I mean, we think the real action will be on the rate side. So there'll be more rate volatility, more uncertainty about the path of rates. And, you know, that's been very suppressed so far. On the equity side, yes, in the very hot parts of the market. So if you're paying very high multiples for very high expectations, and, you know, that's almost a separate point in terms of US market concentration, that's probably not a very comforting place to be at the moment. So we see the NASDAQ is more sensitive from that perspective. So, yes, we do believe that there will be less overt explicit support for the markets, but we think that's a good thing. You know, this is more a kind of normalization, and it really suggests that other markets, you see Europe today, futures are up. Asia had a fantastic year to date. You know, perhaps look elsewhere. Broaden out. This is a good opportunity.
That's an interesting observation. If you do get more rate volatility, what are the implications of more rate volatility for other asset classes? Because this is the kind of the centre of the story.
So, you know, on the income desk at Schroders, we look at, you know, where you're starting from. And if you're starting from very high valuations with very high expectations, add in volatility, that's uncomfortable. When you look at the fixed income, the credit market spreads are at all-time tights, USIG particularly, and that's going to fund the AI trade. There's a lot of kind of leveraging, we think, to come into the system. So anywhere where you see valuations very tight, and especially valuations that are susceptible to a steepening in the yield curve, USIG, 7-year duration being an obvious example, you should be a little bit more careful. You know, the whole idea of 60-40, where, you know, the bond side just helps you out here, you're starting from a very different place. You're introducing volatility to the market.
Where do I hide then?
You broaden out. So you broaden out not just in equities, but you broaden out into different parts of the fixed income market. You look at the mortgage market, you look at agencies or securitized. That's clearly being supported, not necessarily by the Fed, but by Besant and the administration. So, I mean, you know, you follow policy, but policy is less predictable, and it's kind of coming from more sources now. I mean, I think it's a fascinating market, but, you know, you need to think a lot more and follow indices a lot less and worry about index concentration both in bonds and equities, I would say.
This sounds like solid advice for 2026, Dorian. I mean, we've talked in passing about the AI trade.
Yes.
What have you taken away so far from what we've heard from these corporates, these tech giants on both sides of the Atlantic in this supposedly show-me quarter? What have we learnt about the vulnerabilities around software, about the kind of capex to be tolerated? What stands out to you?
Well, it's a bit like volatility coming into the market from the Fed. You know, there's a lot of sensitivity now because the AI capex is anywhere between 3 trillion and 5 trillion. As I said before, it's going to be funded by USIG largely, also private credit has implications there as well. But when you look at the companies themselves, you know, small moves in expectations are driving the prices up and down. So the biggest consequences for us is the breakdown in correlation in mega cap tech. It's come off a cliff. And investors really can't see that as a block anymore. And therefore, if you start thinking like that, you go away from the AI spenders to the AI beneficiaries. You know, the picks and shovels have already done very well in semis, etc. Look at the beneficiaries, look at the productivity enhancements, and probably steer away a bit from those who are footing the bill, because it may work out, but there's more of a risk premium we think needs to be introduced into the market.
Is AI inflationary?
Yes. That's the biggest irony of AI. So, you know, short term it's inflationary because of the resources that it consumes. It takes it away from everywhere else. The most obvious place is, you know, the rollout of infrastructure, energy prices in the States, electricity prices up 7% or something like that across states in the US, and competition with households as well. So, you know, huge short term.
Longer term, is it not, though, because of productivity gains? Or do you have
absolutely,
to be
So, you know, short term inflationary, you lose jobs. Long-term productivity enhancing, you lose jobs
and you gain jobs up front.
Yeah, you gain jobs up front, exactly. So,
Dorian, great to see you.
Thank you
very much indeed for joining us this busy Friday. I'm sorry it was a little busier.
It was a jolt. It was a jolt.
We're used to that in January now, aren't we?
Yes, well, I think permanently. Excellent. Dorian, nice to see you. Thank you very much indeed. Dorian Carell, head of multi-asset income fund at Schroders. Coming up, more Trump, more on his looming Fed pick.
I'd rather say it tomorrow, but just an outstanding person and a person that won't be too surprising to people. It's going to be somebody that is very respected, somebody that's known to everybody in the financial world, and I think it's going to be a very good choice. I hope so.
Is Warsh good for stocks? Well, he appears to be good for European stocks this morning. Different view over in America. Anyway, we're 15 minutes away from the market open. It looks positive. This is Bloomberg.
We are about 13 minutes or so from the opening trade this Friday. We had to think about, of course, the next Fed chair pick. Kevin Warsh seems to be in line. That is according to our reporting. We may get that announcement later today. That is what President Trump has said. European futures are actually on the front foot. We're seeing two different pictures right now when you look at US futures versus European futures across the benchmark. Pointed gains of 0.4%. FTSE 100, though, under a little bit of pressure in the build up to the open. Basic resources, copper, energy, all falling and under pressure in the session today. The DAX pointed gains of 0.3%, and over in France, the CAC current pointed gains of 22 points, up 0.3 as well. That is the guide as we lead up to the open.
Yeah, divergence across the Atlantic, divergence within Europe. Oil and energy prices could be the determining factor there. Let's talk about what's going on in these markets more broadly for 3 minutes with our Markets Live executive editor, Mark Cudmore, who joins us now. Mark, good morning to you. So, drum roll, your views on Kevin Warsh and what he would mean for markets.
I think this is a big moment for markets in the short term in terms of we've talked over this month about some crazy moves and about kind of some frothy price action in markets. This is now the catalyst to change things around. And let me explain why. I think that relative to expectations as priced, this is a surprising outcome in terms of it's kind of enforcing Fed credibility and Fed independence relative to what's priced. This is not going to remove the fact that Trump will never stop pressuring whoever's the Fed official, that he's appointing someone who he expects to deliver a cut at the very first meeting. And whoever it is will deliver that cut at that first meeting and might deliver another cut before the midterms. But the point is, this is someone who has a track record of caring about inflation. Now, they currently believe that the AI will lead to a disinflation wave, and that's why they can afford to cut. But don't have a track record of concern about inflation. Also, he's 55 years old. He has a career ahead of him. He does not want to ruin the rest of his career by being a complete puppet for the Trump. And therefore, he will cut aggressively as far as he can, but not farther than he thinks that will actually destroy the market. And ultimately, the appointment of Warsh shows that Besson still has influence and kind of going, look, if you get this wrong, the Treasury market blows up, which undermines everything and they're trying to do on the right side anyway. So I think because of that, the market's realigning everything. We're going to see a bounce in the dollar short term. The dollar move is already getting overdone. And we're going to see a pullback in precious metals. We're seeing a pullback in crypto, pullback in stocks. So this is going to be a temporary correction of markets. This is not a long-term game change, but a short-term it is.
Can I just come to that long-term game change, though? Warsh has indicated that he is not comfortable with the Fed being as active a market participant as it has been in terms of supporting, sort of via QE, supporting asset prices, et cetera, He feels it's been distorting. The equity market has almost relied on that Fed put, that if it goes down, we'll be rescued kind of idea. And I'm wondering whether that gets degraded under Warsh.
Yeah, probably, but I don't think that's an immediate trading dynamic. Look, ultimately, his views on the balance sheet are very relevant. Part of the reason we're seeing a steepening of the yield curve, part of the reason we're seeing this sell-off, that's a way of being hawkish, of wanting to, lower the balance sheet. I think ultimately, look, if the stock market starts collapsing significantly, that is justification for the Fed to cut rates, and it's reasonable. As I said, he will go for any reasonable term to cut rates. So I still think there'll be a Fed reaction function, and I still think it'll be more sensitive than it would have been under prior regimes, given the administration pressure. It just means the people who are just buying every new top again and again on thinking that there's no way this can fall, they're the people who are going to correct it, which is why there's a short-term turning point that might last for a couple of weeks. It's not a long-term game changer at all.
OK, a short-term turning point, not a long-term game change as a result of this nomination or this pick, if we get that. Bloomberg Markets Live executive editor Mark Cudmore on the market reaction to news around Kevin Warsh. Mark, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's get your stocks to watch with Chloe Millet now. Chloe.
Good morning, Tom. It could be a great day for Adidas this morning after the company reported stronger than expected profits and also announced a new buyback. And so this could help lift the shares for Adidas after, as we can see here, quite a few months of underperforming its most direct rival, Nike. And analysts are saying that those strong results and this buyback really show confidence in the brand and saying that their momentum could go even further next year because, after all, it is a year with a lot of sporting events. And we have got things like the Football World Cup, for example, that Adidas could really capitalize on. Moving on to Swatch, and there is quite an interesting story because we have got 2025 profits that fell massively and missed expectations because of US tariffs and because of weakness in China. But at the same time, the company said that it expects 2026 to be a year of substantial growth. And so, interestingly, this is also a company that is outperforming Richemont, which is another name in that watchmaking sector that has also provided quite an upbeat outlook. So we'll see how this picture changes this morning if investors focus more on the 2025 results or the 2026 outlook. And finally, to close out this trio of retail names that I've picked out today, we have got Pandora, which has been cut to a hold at SEB Equities, and this shows maybe a little bit of uncertainty going into the earnings next week for that jewelry maker, and this could put further pressure on the shares after, as we can see here, a massive downward trajectory for that stock.
Chloe, thank you. Chloe Melly with those stocks to watch. We're watching, of course, how the European market diverges from the States, how it diverges within itself as well. And interesting to look at the commodity markets. It is a function of the dollar strength that we're seeing this morning. But silver prices down by 8%, platinum down 7%, gold down 4%, copper down 2.3%, and oil prices, as important as those are, down by 1.9%. Yeah. There's also that focus on oil going into the weekend, a little bit nervous given everything that's manoeuvring around the US military space around Iran. But yes, oil prices for the moment down, and down quite substantially.
Yeah. There's also the kind of month-end effect, which I just wonder what impact all of that is having. Tom and I were chuckling before the show. What's silver up still? It's year to date, it's still
up 50% year to date. Maybe a little shy of that now, given the drawdown that we see, but still up around 50% year to date, which is just incredible. Nasdaq futures, interestingly, turning a little lower than they had been at the start. Yeah. So now called lower by more than 1%. So let's not forget that the tech story and what happened with Microsoft yesterday and SAP in Europe still part of the mix.
What does Apple do today? I don't know. That's going to be a really interesting one to watch out for. And does Microsoft fall further towards some of these key targets that technicians are watching? There's sort of big things still happening on that front as well. Anyway, 5 minutes to go. Market open is next. This is Bloomberg. It is a busy Friday. There is a lot to think about this morning. This guy certainly providing a lot of catalysts for different asset classes around the world. Kevin Warsh looks like he could be the next Fed chair. We're going to get an announcement this morning, we think, from President Trump. Expectation is now firmly in favour of Kevin Warsh being that next Fed chair. That's going to have an impact on the market. But we need to quickly recap where we were yesterday. Yesterday's S&P session really was quite amazing. Microsoft getting absolutely smashed. Meta, a slightly different story. Then we get Apple overnight, but we've got the Fed story to plug in as well. There is an awful lot going on. Europe went out there. The US closed up there. So there's a little bit maybe on the upside. Maybe that's the factor we're seeing in Europe this morning. But this is what the picture looks like on the other side of the Atlantic this morning. Nasdaq futures are down again. Not down a lot, 1%. The Russell's down 1.5%, which I think is interesting as well. So that's unwinding. S&P's down by 0.9%. Is that to do with technology? Is that to do with Warsh? It is hard to determine exactly what is what this morning. But what we know is that it's a different picture over here to what it is over there, Tom.
Yeah, so far, European futures looking through what could be, at least relative to other scenarios and other picks, a slightly more hawkish Fed chair. European futures pointed to gains of 0.3%. There was some bloodletting in the tech sector yesterday, which lost more than 3%. SAP was a big factor there. Will we see a bit of a turnaround in the SAP stock? Because DAX futures are pointing to modest gains of 0.1%. Adidas will be playing a role there as well. A slightly brighter picture there. FTSE 100 futures pointing lower by 14 points. Basic resources, gold, silver, going to be a weight and a drag on the FTSE 100 today. Anne.
They absolutely will. We'll watch Adidas beating estimates, announcing a share buyback. Swatch in focus. I've seen expectations it goes either way at the start of trade. And certainly we'll watch the SAP share price for a second day as it was down 16% in yesterday's session, Guy.
Does it bounce with Nasdaq futures as down hard as they are at the moment? SAP, I think that's going to be critical for the German market to watch this morning, but it was a big move yesterday. So we'll wait and see what happens with Germany in just a moment. We'll have to wait maybe 2 or 3 minutes for that. The FTSE is weak. Now, that's understandable this morning. You think about the metals trade, you think about what is happening in energy, all of that plugs into the FTSE and gives you maybe a more negative read on what is coming out of London. So it is down 0.3%, pretty much in line with what we were expecting. The CAC, maybe a few fewer stimuli for the CAC this morning. So it kind of comes through fairly static. The IBEX is up. I'm just wondering if that's the banking sector. What else are we going to be watching within the banking sector? We talked to the Caixa CEO a little bit earlier on. Interesting conversation there. The DAX and the SMI are going to take a little while to get going. The DAX is going to be fascinating this morning to see how it trades on that SAP story, plus Adidas. So there's a lot of things to fold into this market this morning. Tom, what are we seeing in sectors?
Yeah, you touched on Spain and GDP, interestingly, rising 0.8%. Just a reminder that the growth picture continues in Spain, and there's some resilience there, as the CEO of that bank was telling us. Across your sectors, not, of course, unexpected. Basic Resources taking the biggest hit, down 2.3% right now. On the upside, it is banks, up 0.8%. And again, the earnings momentum continues. They are posting decent numbers, these European banks, and not seeing major hurdles through 2026. That is top of the list then, the banking sector. Basic Resources, again, at the bottom of the list, down 2.3%. And just refreshing to see as I can see some individual names. Anna, you got some detail in terms of what's happening under the hood.
Yeah, absolutely. Well, it's interesting that the Spanish story, the growth story in Spain and the banking story come together this morning, because one of the standout stocks to the upside is CaixaBank, up by more than 2%. We were talking to the CEO earlier on, very positive take on the Spanish economy, saying he sees no clouds right now, clear skies for Spain, and CaixaBank is going higher as a result. So that's one of the reasons that we have a slightly different story to tell, perhaps, here in Europe this morning versus what we're seeing in global markets. But Basic Resources and Energy very much reflecting that stronger dollar global picture, aren't they, this morning? Those are the worst performing sectors, very much on the back foot.
SAP has bounced. It's up by 3%, but that feels fairly small compared with the drop that we saw.
A small fraction from yesterday.
Absolutely.
Rio Tinto down 2.2%. Glencore down 2.8%. So it's the miners. That seems like such a clean trade at the start of the year, didn't it?
Yeah.
And now question marks over that. But for how long? Energy,
defence, pharma. There's Airbus in there. Airbus makes 220s in Canada. I'm just going to float that one. It also makes them in Alabama as well, according to Benedict Campbell, who I've been talking to this morning about this. So maybe they've got a little bit of an out on the Trump trade surrounding Canada and aviation. But it is the miners. It's miners and pharma. Astra's down 0.7%. That's the second biggest points drag on the market. So it's not just the kind of the energy commodity story. Miners that are doing the damage to the downside.
Even with a bounce of only 3% from SAP, technology is the second best performing sector, and some of that is to do with that SAP move, because it gave up its title as the biggest company in Germany, but it's still a big company.
And the sell-off in the European session on tech yesterday was dramatic, wasn't it? So making out for some of those losses.
Yeah.
Should we get a broader perspective right now, get the analysis, and bring in Maria Minichi, multi-asset fund manager at M&G Investments. We'll get into the weeds and the guts of the market, but I want to start broad line, top line, with the Fed chair pick. We expect Kevin Warsh, and whether that changes your view. You are underweight US equities anyway. Does that just underscore that negative view on US stocks? How do you think about a potentially, at least compared to other picks, potentially more hawkish Fed chair than we had expected, at least?
Yes, this seems to be the first reaction the market is posting this morning to this announcement with the dollar strengthening. I think the new Fed chair will have some very interesting challenges in front of him. The first one to me is the data that still remains quite mixed in the US. So we've heard from Powell earlier this week about how growth is strengthening and is in a strong footing for 2026. On the labor market, we had a stabilization. We've seen unemployment in the US going down to 4.5%. But on the other end, the payroll number is still relatively low compared to what we had in the last few years. So I think that is something that remains very crucial to watch on what is happening on US labor market in the next few months. The other challenge will be, obviously, one thing is setting the target rate, but the other very, very important job of the Fed chair will be communication. And this will be crucial because I think the world is watching. And having said that, I think, it will remain very data dependent, I believe. And for what concerns the implication on US equity markets, I think it's very, very interesting what we saw last year. Because despite rates going down quite significantly in the US over the course of 2025, valuation on the S&P has not moved. What has driven the price gain of last year was earnings growth. So I think we kind of potentially reached the cap on valuation. And this is one of the reasons why we're less positive on the US equity markets. Obviously, there are opportunities for stock picking, but we do prefer developed markets outside the US, like Europe and Japan.
So, sorry, on the earnings picture, you think earnings growth is starting to top out in the US?
I think earnings growth is very likely to continue in a positive path. I mean, that's what we get from earnings expectation. But the valuation piece is very unlikely to be on your favor, because as we've seen last year, despite rates coming down, that has not moved. So you haven't benefited from rates coming down and gaining on your valuation. Valuations are pretty stretched.
That's really so valuations are really stretched in the US, and I'm wondering what you're making of the tech earnings season so far, Maria, because we've had within tech in the United States, we were having a conversation half an hour ago with a guest who was saying, you can't talk about the Mag 7 anymore. There are such divergences between them. So in your underweight on US stocks, is there a divergence around the way you see the Mag 7 or not?
So overall, we obviously S&P 500 today is very dominated by tech. So within the underweight, there is exposure to tech in general. But within that, as you were saying, we have seen very, very different behavior. And I think one area potential of interest today is the software space, because already towards the end of last year started to suffer. I think there is very much belief from an investor standpoint that there is a threat for the market from AI, and in particular agentic AI being able to replace some of the work done by software companies. I think our views is more that there is a possibility that corporates will continue to be willing to pay for that service, to outsource their softwares, to enhance the security of that software, especially if it's a non-core part of their business. So potentially some of the discounts we've seen, throughout the last few months, and in particular, they've really accelerated now. In January, we've seen yesterday quite a strong sell-off in the software space in the US. That could present some opportunities.
That's interesting. So
over the medium term.
We don't have to talk about SAP specifically, but of course that comes to mind, given what we've been discussing this week. Does that mean the selling in that sector is overdone? I mean, it could weigh on prices, perhaps, their ability to price for those products, even if it doesn't mean AI, entirely obliterates them. What's the thinking there?
Yeah, I think, you're starting from an earnings growth perspective that is still very elevated. So when you see, potential miss, you're looking at very small numbers over pretty elevated earnings growth expectations still. So that's to put it in context. I think you have an issue of momentum. So there are clearly on a negative momentum at the moment. But over the medium term, potentially at some of the de-rating that we've seen on this sector, there is opportunity to be selective and pick some interesting stocks.
Volatility is very low. Does it stay low?
Well, it is definitely still very low, and that has been very interesting to be seen in the context of what commodities have done.
Yep.
Because many people have been talking about commodities as a diversifier.
Yes.
But the truth is that we didn't really have a lot to diversify against, because equity markets on the whole have remained relatively resilient, depending on your time frame, obviously.
Yep.
Volatility has remained relatively low. So actually what we're seeing in the commodity space might not necessarily be seeking diversification, because you didn't really have a strong risk-off environment for now. But
so what was it?
What might have been is more risk-seeking and actually profit-seeking in some
these
areas.
are speculative assets, not safe haven assets.
Well, there are structural stories behind it. Obviously, the debasement versus the dollar.
Yep.
We had geopolitical risks coming to the
Yep.
fore. We also have, more access to markets like gold through ETFs that are easily accessible by every investor. But I think there has been more, willingness to participate to the gains rather than diversify towards risks.
Okay, so then, where do I seek safety then? If it's not in those kinds of assets, they're not diversifiers, they're not uncorrelated. Come back to the volatility question. The market keeps being short vol. Why is the market short vol? Is that the place to, if I'm looking for diversification, is that the place to go to?
Well, I think it depends what type of risk you're trying to diversify against.
Okay.
When we think about a multi-asset portfolio, the key risk you're trying to diversify against is risk-off in the equity space, because this is the key driver of your return over the long term. And I think, in an environment where that risk-off is driven by growth deteriorating, you still have some very strong bet by having an exposure to duration. And in particular today, long-dated bonds and long duration, it's an area that is, I would say, very unliked by many investors.
So you still think the 60-40 kind of structure is going to work? That kind of bonds are going to be my ballast?
In some environment, in a growth scare environment, I think you might still get good diversification because of where the yields are there, because where the real yields are today and where inflation is. Obviously, if your risks are coming from worries around inflation picking up, that's a different story, and we've seen that playing out in 2022. But again, it really depends what you're trying to diversify against.
Okay.
I want to go back to your view on US equities. You talked about valuations being one of the headwinds, and you're underweight US stocks. To what extent are you making an assumption about further dollar weakness as part of that view as well?
So we tend to take currency as a separate call. We tend to get exposure to our equity market in local currency and then view the currency as a separate call within our portfolios. And normally we tend to favor currencies where we see attractive positive carry. And that has actually been a very positive strategy throughout 2025. And we continue to see opportunities into 2026.
What's the best carry trade right now?
So I think if you look at many emerging market currencies, you still find some very attractive carry. Obviously, that has compressed because 2025 has been a very favorable year. But emerging market currency continue to offer some very interesting uplift in terms of carry and returns.
There's a lot to think about. Maria, thank you very much indeed. Great conversation. Maria Manucci, multi-asset fund manager, joining us from MG Investments. Core 6 looks like this morning. Let's take a look at some of the key stocks that we keep an eye on. You've got actually a bit of softness in ASML this morning, which is interesting. Looking at what is happening stateside, that feels kind of logical. Pharma is quite spread out. Novo's up. LVMH is also benefiting this morning. Swatch is having an absolutely cracking session so far. Adidas is another stock in focus as well. Let's get some details with Chloe Mellet.
Good morning, Guy. Adidas is having a pretty good day. It is up about 4% this morning after reporting stronger than expected profit and announcing a new buyback. So investors see this as quite encouraging results, reassuring after the company has been facing a lot of currency headwinds and, of course, has been dealing with US tariffs as well. And it seems that this momentum is also expected to continue this year. So it's a pretty good day so far for Adidas. Moving on to miners, and we have not been used over the last few weeks of seeing them in the red, but they are in the red today as gold fell, and that is because Trump is expected to nominate Kevin Warsh as the new Fed chair, which would be considered quite a hawkish pick. And so we are seeing that reflected there in weakness across that mining sector this morning. Moving on to Swatch, which, as Guy mentioned, is having a pretty good day, and that is because its outlook for 2026 is very positive, very upbeat, despite having had a really tough 2025 marked by tariff uncertainty and, of course, weakness in China as well. But it said that 2026 will be a year of substantial growth, and it seems that is what investors are focusing on this morning, and we are up at 5.5% for that watchmaker. Moving on to airport stocks, and those two were upgraded this morning by Jefferies, mentioning that 2026 will be a year of higher traffic because of airlines boosting capacity, and that will be a good news for those airport operators. And finally, Auto One, which operates a platform where people buy and sell used cars, has just been given a new street high price target by JP Morgan, and that is really boosting the shares this morning. We're up about 4% for Auto One.
Chloe Mellet, thank you very much indeed on some of the stocks on the move. Let's reflect on what's happened to SAP. What a tumultuous week it has been, of course, for this key enterprise software company. We spoke to the CEO yesterday, and it was a brutal session, of course. Double-digit losses for SAP yesterday. Here's the move over 2 days then, still down close to 14%. They're seeing a bit of very modest relief, just up 3% so far. We continue to have that discussion as to what happens with the software space, the competition from some of the AI startups nipping at the heels in terms of the software story on the enterprise space and where the value accrues. Christian Klein saying it will accrue at the app layer and the software layer.
Yep.
The question is, when does that happen? For now, there's little patience, a little bit of relief at least coming through in the session today, SAP, but relative.
Yeah, the 2-day charts. And in some ways, you need the 3-day chart to see the gap lower, the kind of gap lower that we saw coming through.
Coming up, Adidas shares, they are gaining on the back of its earnings beat, as we heard. But over the longer term, we're going to ask, are we Pete, Gazelle and Samba? A photo there of Guy Johnson's shoes. That's coming up. This is Bloomberg.
Welcome back. 18 minutes into the session. This is what equities look like here in Europe. Generally a positive picture. Germany and Spain are outperforming. Banks are doing the heavy lifting. Technology bounces back a little bit. That's the SAP story, you could argue, but still down very heavily over 2 days. Luxury is actually having a fairly solid session. Swatch leading the charge there.
OK, some watches to shoes. The sneakers are also performing when it comes to Adidas. Shares higher after reporting a prelim fourth quarter profit that beat estimates and announcing a buyback programme of as much as €1 billion. Bloomberg's Tim Lowe joins us from Munich with the details. Tim, what is your take on the Adidas story? Is this a significant and material turnaround for the company?
I think it's Adidas coming out and saying, listen, we've been performing well for several years, and particularly in the last 12 months. Investors have been shying away from us. Investors have had questions about the whole sneaker and sports industry. And, it's bled into whether Adidas can keep up its hot streak. And Adidas is coming out today and saying, yeah, we can. We believe it. We're putting our money where our mouth is. We're going to buy back shares while they're so cheap. And we welcome anyone to join us who'd like.
OK, yeah, so that's certainly having an impact, and that share price up pretty strongly, up by just shy of 5% then this morning. Elsewhere, what did Swatch have to say, sticking with the consumer products space? I saw the numbers, and the backward-looking stuff looked as if it had missed, but the guidance so strong, and that seems to be where the market's focus has been.
Yeah, it's like so many things in the last year. The first half of 2025 was really brutal for them. I mean, you had the tariffs, you had China slowing down and whatnot. But people who were looking closely at a company like Swatch noticed that in the third quarter, growth was accelerating. They'd kind of bottomed out. In the fourth quarter, it accelerated even faster. So today they came out and they put in, full year numbers that disappointed, but they showed that the growth is picking up. And they said, importantly, that the early figures from 2026 shows this growth continues to speed up. So it was a pretty optimistic, forward-looking statement, and I think and they also mentioned it across all price points and different models. So I think investors are diving in there, hoping they've already seen the bottom and that some of those bad data points are just going to keep getting better.
Tim, thank you very much. Bloomberg's Tim Lowe with an update on some of those consumer product companies. There was a time we were really worried about watchmakers and competition from smart watches. Let's go to smart tech. And Apple's shares have fluctuated in after-hours trading after the company delivered record quarterly sales and an upbeat forecast. Given, Tom, given the scale of what we've been seeing around the tech sector this week, that an after-hours move of 0.5% feels like nothing, doesn't it? For a company like Apple.
Bit of a letdown, Apple.
Yeah, I mean, on the one hand, there were negatives, weren't there, around thinking about costs.
Wearables growth actually slowed. But costs, that for me is the line that stood out from Tim Cook. I mean, look, let's take a step back. First quarter, it was a record for Apple, and China came back with real strength. You saw growth there of 38% or so. So really strong in China, which is pretty fascinating given just how competitive that market is. And the iPhone 17 still doing really well, even though it has essentially no AI embedded into it as yet. That's a 2026 towards the second half story. But what really stood out coming back to this is what Tim Cook said about the potential squeeze on margins because input costs are going out, particularly in terms of memory. We've been hearing from the South Koreans and the Taiwanese CEOs saying that is going to be a longer-term trend. We're going to all be paying more for our electronics. When do you start to get pushback? It's inflationary. Inflationary. Let's take that to the central banks. How significant is that? And is that being underestimated by our central bankers?
A couple of things on this, one of which is the NASDAQ is down pretty hard, so 0.5% looks a lot better if you think about the fact that it's the NASDAQ is down. So maybe that needs to be sort of factored into what we're looking at here. The other one is, if you take it back to the conversation we had with SAP, why do I need a keyboard? Like, was it SAP? Why do I need a keyboard? Why do I need hardware? I'm going to be talking. AI is going to allow me to talk to things rather than have to have something in my hand and have that sort of physical form factor. Why do I need a phone in the same form factor that I've had for quite as long as I've had?
I don't think the whole newsroom needs to listen to me interrogate my expenses report personally out loud. It would be a huge change for the workplace, wouldn't it? If we didn't have keyboards.
So I think so. Neck braces are going to be. So at the moment, everybody walks around like this, sore neck, looking at their phone. You won't need to do that anymore. So people with this is great news for people with stiff necks.
The makers of neck braces.
But people also are going to bump into things less. because they walk around like this with their phones. So I'm just wondering what the kind of the wider effect of this
all the potential upsides of agentic AI. There you go.
Precisely.
Microsoft has agentic AI, Copilot, but they don't seem to be...
Which I'm sure you can talk to at some point.
You will be able to converse with Copilot. And they talk it up, and they're selling some of it. Consumers and their enterprise customers are buying Copilot, but probably not at the pace that many of their investors would hope. They have a backlog when it comes to data centers. They're not able to build as many data centers as they need to match the demand that's coming from the likes of OpenAI. They have a huge contract at OpenAI that's going to support that part of the business. But the cloud part of the business, to what extent their clients, their enterprise clients, are using their cloud, that growth missed, and then you just saw that being matched with the capex spend, and this is the response. Look at that chart. Off a cliff for Microsoft, an historic drop.
Yes.
Is this a buying opportunity for Microsoft, or is it a major warning sign that finally the ROI question has come home to roost?
Some people, we talked to Maria Minucci, and she was floating the idea that maybe software stocks have been oversold on concerns about competition from AI. Clearly, Microsoft's a bit different because it also could benefit in some areas of its business. But there will be those with that view that there's going to be a buying opportunity.
The head and shoulder, everybody got very excited. Cameron Cries. Go and read Cameron Cries on the Bloomberg about this. His head and shoulders, all that sort of stuff. He flagged it a while ago. We've all been sort of watching the Microsoft chart ever since. And yesterday was the kind of crescendo of that narrative. Let's turn to another aspect of all of this and what is happening with SpaceX, XAI, and what is happening with Tesla. Bloomberg has learned that SpaceX is now considering a possible merger with Tesla, or an alternative combination with Elon Musk's XAI startup. Bloomberg Tech Co anchor Ed Ludlow broke this news and told us a little bit more about what could happen next.
There are two distinct scenarios being looked at. My understanding from sources is that there has been a consideration by SpaceX of a merger with Tesla, and the companies have looked at the feasibility of merging private SpaceX with publicly traded Tesla. Alternatively and separately, SpaceX has held talks with XAI, Elon Musk's AI lab, the maker of Grok, about a combination of sorts. And, you know, the only thing to add to that really is that there is a body of investors, I understand, that have pushed the Tesla SpaceX option. As you know, like, the background context is that we've reported SpaceX is preparing for an IPO targeting the middle of 2026 this year, in the hope at raising funds far beyond $30 billion, $40 billion, $50 billion, because they need capital to buy GPUs for space-based data center. Historically, like, it's completely normal for different Elon Musk companies to work with each other. There have been engineers that have worked on materials, for example, at both Tesla and SpaceX. XAI uses energy products from Tesla. As of this week, Tesla is an investor in XAI. It bought $2 billion of preferred equity in the Series E. SpaceX is an investor in XAI. It is participated in a prior round as well. So these are being looked at. Nothing is final, but both options are being looked at.
OK, Bloomberg's Ed Ludlow there. I think a key takeaway is that Tesla is becoming far less of a car company. And more maybe of a space company, more of a robotics company, more of an AI company.
We were asking that yesterday, weren't we? What is Tesla now? It seems as if, depending on which way this goes, either we get more data centers or more robots in space. That's my conclusion.
Why do you need Tesla for that? Like, what is... you could just do it in the other companies, couldn't you? SpaceX. What do you call the entire company? Anyway.
Come out, gold in focus. We'll certainly keep our eyes on what's going on with precious metals. This is Bloomberg.
Happy Friday. This is the opening trade. We are 30 minutes into today's session. So we're thinking about the Fed and potentially Kevin Warsh at the top of the Fed. And that announcement could come, of course, today. European stocks on the front foot, up 0.3%. Some really interesting dynamics to play. It's banks, it's tech on the upside today. SAP getting a bit of relief over in Germany. On the downside, basic resources with the pressure coming through across the commodity space. The DAX then up 0.7%. I mentioned SAP, Adidas also in the mix there. The CAC current over in France, up 0.3%. The FTSE 100 just clinging on Gold's gains of 5 points, despite the pressure coming through on the basic resources space. Guy.
OK, let's talk about what is happening on the internal front. We've got 377 up, 203 down. So on balance, we are positive, and you can see that in Tom's numbers. We're a little light on the volume, but let's not read too much into that. Let's talk about where the leaders are, because this is where life gets interesting. SAP is bouncing, but this doesn't feel convincing at this point. We're up by 3.5%, but yes, that pales into insignificance compared with the drop we saw yesterday. Doesn't feel like a big buying of the dip. Adidas is up quite nicely. Swatch is also bouncing. I saw the numbers first thing this morning and they look negative. And then you look at the outlook statement, which is quite positive about what 2026 looks like, and that is what investors are looking at this morning. Luxury, as a result, is getting a nice lift off the Swatch outlook this morning. We're up by 7%. Where are we seeing weakness? It's a reversal of what we've seen of late. Rio, Glencore, both down. The mining story, the metal story is coming off the boil a little bit. Can we point to Kevin Warsh for the reason for that? Maybe the dollars maybe gaining a little bit of traction. You're certainly seeing metals coming down. You're also seeing energy coming down a little bit as well. I'm talking about Brent here. So BP is a little softer on that. But we still don't know what is going to be happening with the Trump story on Iran and where he takes that next. So just keep an eye on that. That feels like more of a wild card to watch as we work our way into this weekend, Anna.
Let's get an update on some of the other stories we're covering this morning. Then Bloomberg understands India's probe into last year's Boeing 787 crash is increasingly homing in on deliberate pilot action as the probable cause. Authorities had previously been resistant to that as a scenario. We're told investigators have ruled out mechanical failure and have not found evidence of sabotage. A final report on the causes of the Dreamliner crash is due by June. President Trump and Senate Democrats have reached a tentative deal to avert a disruptive U.S. government shutdown. This as the White House continues to negotiate over placing new limits on immigration raids that have provoked a national outcry. However, lawmakers are almost certain to fail to enact the measure before a Friday night deadline, meaning a partial government shutdown is now seen as the most likely scenario. And gold retreats as the U.S. dollar strengthens after reports have emerged that Donald Trump is preparing to nominate Kevin Warsh for Fed chair. Prediction markets showed a surge in bets earlier on Warsh being chosen. The US president is expected to name a successor at the Fed today. Tom.
OK, and that story, of course, and the potential nomination of Kevin Warsh is having ripple effects across the asset classes, including, of course, commodities. We talked about that in terms of energy, oil, copper, gold, silver, all under pressure on expectations that, at least compared to other members who may have been picked, or at least potential nominees, this might be a slightly more hawkish pick. Let's listen in to what the president had to say last night about the Fed.
Well, you have other political people on the Fed, absolutely. You have political people that will vote against Trump or a Republican, but in particular Trump. But we've done so well with the economy. You see the numbers. We're getting the best numbers that we've ever had as a country, and that's despite the fighting. We've broken the Fed wall. I mean, they could have been much better. It could have been much more helpful to the country. But even despite the little bit higher interest rates, you notice that the interest rates now are falling despite the Fed.
The president speaking there last night. Joining us now is Tulan Nguyen, Commodity and FX Research Head at Commerzbank. Tulan, good morning. Thanks for joining us. Does a potentially more hawkish, at least more hawkish than expected, Fed chair change significantly, structurally, your view on gold through the rest of 2026?
I wouldn't say so, not yet. And I wouldn't necessarily call the new Fed chair more hawkish if it were to become Kevin Warsh. I think the difference between him and other candidates is more the loyalty factor. So markets are doubting whether Warsh will be as loyal as someone like Kevin Hassett, who has been a loyalist for quite some time with respect to Trump. I think Trump has made relatively clear what he wants from a new Fed chair. And if that Fed chair doesn't deliver, the attacks on the Fed are unlikely to subside. So this whole issue won't disappear, even if Kevin Warsh, who's seen as more hawkish, as you say, will replace Powell.
So you think the debasement trade continues, and you think there's further upside then? Would you you'd be buying the dip in gold and silver in the session today?
I mean, obviously, with current market dynamics, it's very difficult to make a forecast here. But what we've seen in the recent past is that when we saw a correction downward, this was often enough taken as an opportunity by the market to enter new long positions. And usually the correction didn't last long. So basically, we have to look at the drivers of the recent uptrend. And obviously, there are several factors. Obviously, there's only one, but one part really is the erosion of institutional credibility with respect to the Fed. So that's one factor. Yes, as it looks right now, maybe Fed independence can be defended. But then there are other, obviously, factors which have been driving up metal prices, such as the geopolitical situation in general and also the fiscal risks. I wouldn't underestimate. I think because these fiscal risks, I think they have been around for some time, and they won't likely disappear in the foreseeable future.
How speculative are these trades, though, and therefore how quickly can they change?
I mean, obviously, the price increases, the dynamic has been accelerating quite a bit. And so really it looks a little bit like a rational bubble as well. But as the word says, it's rational from a point of view that investors increasingly go into it because they expect it to continue. And then it becomes a self-fulfilling prophecy. And this can go on for some time until we have an actual trigger, a fundamental trigger that reverses this trend. And that is the most difficult to forecast. When will this trigger come? But obviously, yes, just as high as the price has gone, it can come downwards again. Yeah. But obviously, we need a trigger for it.
But you don't see Kevin Warsh at the Fed as being that trigger?
Not yet. I think this will be a medium to longer term trend. Once Kevin Warsh is in place as a Fed chair, we have to see how he will conduct himself and how monetary policy plays out. And I think until then, uncertainty remains quite high.
Thulan, can I broaden us to other commodities and focus in on what's been going on with copper? How concerned are you about demand destruction in copper at these relatively elevated prices compared to recent history?
I would be concerned about that because we've received some hints, particularly from the most important market, which is China, where consumers of copper have avoided to buy copper outright for the time being. Obviously, this will not be sustainable because copper, and that's the reason why copper has been so volatile and other industrial metals in general, because they are used, they have an industrial use and they cannot be substituted easily. And therefore, there isn't structural demand for these metals. So I think there is some case for some demand destruction, but copper is a structurally relevant metal for the green trend, for the energy trend, and therefore I think we can only bet on limited demand destruction, which could pull down the price.
I see. Okay, so that's copper. Let me ask you about oil prices, Thulan, because we see lots of, the whole commodity space is weakening today. We're showing lots of this on our screens. We've got silver prices down 10%, platinum down 10%, gold. This is very much the dollar effect, and it's the Warsh story. We also have weakness coming through, not to that degree, but 1.5% down on WTI, for example. How are you thinking about oil into the weekend? The market seems to be a little unclear as to what the US administration's intentions are with regards to Iran, and that might leave people a little uncertain about the weekend.
Yeah, I think exactly that, because we've seen in the past that there were military actions usually on the weekend. So I'm very doubtful that the market would go into the weekend with short positions on oil. So I think the downside, especially in oil prices today, will be rather limited. Obviously, it depends on the rhetoric that we also get throughout the day with respect to Iran. But as you say, I think this uncertainty on whether something could happen on the weekend, this will limit the downside in oil prices.
Tulan, do you see Europe diversifying away from US LNG?
I think that's very difficult at this point. We've seen with the recent de-escalation surrounding the Greenland conflict that they are still trying to make a trade deal. And I think LNG will be a significant part of that deal because the Europe or the EU has said that it will increase imports, energy imports from the US, and LNG will be, as I said, a great part of that. Also, we need another source of LNG. Remember, we still are sourcing some natural gas from Russia, which will end at some point. So we need another source, and there is no other big producer outside US which could fulfill that demand.
Okay, Tulan, thank you very much indeed across the commodity space today on a big day for that particular part of the markets. Tulan Nguyen, Commodity and FX Research Head at Commerzbank. Thank you for the analysis. Coming up, what percentage, kind of links together, because of course these input prices for cars, what percentage of cars sold in Europe are made by a Chinese brand? I'll give you a hint, it's been going up. The answer when we come back. This is Bloomberg. Welcome back. Now, before the break, we asked you what percentage of cars now sold in Europe are made by a Chinese brand. The answer is 9.5%, almost 10% of all cars now sold in Europe are made by a Chinese company. Figures from research firm Dataforce show that Chinese brands built nearly 1 in 10 passenger vehicles sold in Europe last month. Further Bloomberg analysis showed that Chinese brands accounted for 16% of Europe's EV car market in December and 11%, 16% for EVs, 11% for all of last year. When accounting for non-Chinese brands like Tesla, which has suffered in Europe, and VW, a staggering 1 in 7 EVs sold in Europe are now made in China. The UK is a major market for companies like BYD now. Guy.
Let's talk about what that means for Keir Starmer, because he's in China. He is speaking a little bit later on at the China Business Forum. He's taking a little bit of, he's getting a little bit of a hard line from Donald Trump, but not as hard a line as Mark Carney's getting. So some might take that as a win. From 9 a.m., Italy, Euro area, German GDP, 1 p.m, German CPI out a little bit later on. ExxonMobil, Chevron and American Express all out with numbers. Got the deadline for the US government shutdown. Which way does that one go? US PPI is out at 1:30, and we've got Alberto Muslim and Michelle Bowman speaking a little bit later on, 1:30 UK time, I should say.
Let's get an update on what we should look ahead to then. So those are the things in focus. Skylar Montgomery-Koning joins us. I know we're going to ask you about Kevin Warsh, so we'll do that in just a moment, Skylar. But I want to ask you about shutdown risk, because I'm fascinated. I've dubbed this Schrodinger's shutdown, because it appears to be both averted and not averted all at the same time. So what risk still exists around this shutdown?
Yeah, I mean, I'm not really sure there's that much risk to asset markets, particularly when you have so much else going on, as in because there's so much focus elsewhere with kind of stretched positioning, commodity markets coming out, questions around the Fed chair and what the board looks like, et cetera. I'm not sure you're going to have that much focus on the shutdown, especially because it didn't really have that much impact last time around. As in, if you look at the period that we had the shutdown where you weren't getting data, the biggest thing was that you just weren't getting data. So you didn't get a clear read on the U.S. economy, which actually meant that you had U.S. yields and the dollar kind of stuck in a range. Now, the situation is a bit different now because other forces have forced both of those out of their ranges. But I think largely you get them resolved eventually. It's kind of a distortion on data. It makes it harder to do your day job in terms of where's U.S. growth going and how does that impact asset markets. But it's not big enough of an economic impact that it really feeds into markets.
Kevin Warsh, what do you think?
Yeah, I mean, I'm still cautious on kind of confirming it, given there hasn't been an actual announcement. So this could very well change. But we have seen a pretty decent market reaction, especially as there aren't as many questions around whether or not he'll get confirmation, given he's more of an orthodox candidate. Now, that's boosted the dollar a bit. Part of why is I think you're moving past the uncertainty that takes away a downside risk. It's also not a totally left field candidate or one where there is a higher likelihood that the central bank's independence comes into question. So you've moved away from kind of the worst case outcome for the dollar. I think unlikely, though, that we'll get a big dollar move off of this.
OK, Bloomberg, Skyler, Montgomery Koning, thank you on the macro and on Kevin Warsh. Let's get back to a key business within Europe on the startup side, really performing in 2025. Travel booking platform GetYourGuide has crossed €1 billion in revenue after achieving profitability last year. The milestone is fueling speculation over whether the company could soon tap the public markets. Let's bring in Johannes Reck, then co-founder and CEO of GetYourGuide. Johannes, thanks for your time. So they're hitting the metrics, €1 billion of revenue in 2025. What underpinned that growth, and what are you targeting in terms of revenue growth in 2026?
Great to see you again, Tom. Thank you so much for having me on the show today. We've had a spectacular year in 2025. We were the first global experiences platform that crossed the €1 billion in revenue. This is a milestone that I, as a founder, have waited for more than a decade. And that clearly puts us into the category leadership in one of the most exciting spaces there is. The experiences economy at this point in time is more than €400 billion in spend a year. And it's really gone from being an afterthought and an add-on, a decade ago, to being the key source of inspiration for travelers around the globe. So looking forward, what does that mean? Obviously, there's a huge AI disruption coming up in the travel ecosystem, which we believe will further fuel the growth of our platform. And we are really incredibly excited about the growth trajectory that we're currently seeing. We see growth across all of the major markets, Europe, the US, and Asia. And we're very optimistic about this year, again, leveling up even further to the fantastic 12 months we've had.
Well, we certainly want to get more of your views on what AI does to the industry, Johannes. But before we get there, so €1 billion in revenue, you're profitable. What's the IPO strategy? Is that in the pipeline for 2026? Do you go public this year? And if so, where are you looking?
A company like ourselves that is now north of €1 billion in revenue, which equates to more than 4 billion in sales that have been done over the last 12 months. So that's 33 million experiences booked and cash flow profitable, being able to fund, your own growth means that you really can take a long-term view. And I, as a founder, I've been with this business now for more than 15 years. I believe that the brightest days are still ahead of us. I think there's still a ton of opportunity in the experiences industry to further digitize our massive supply base. We now have more than 50,000 businesses selling on GetYourGuide, 200,000 experiences that are listed. But there are more than 1 million globally that we can capture, and the market is growing fast. So new experience creators are coming on the platform on a daily basis with really interesting offerings. Anything from very cool tours in Slovenia to major attractions like Disney. So it's really about the execution against that market opportunity.
So what about an IPO in 2026, Johannes?
We keep all of the options for our shareholders open. We will create optionality, but at the same point in time, it is not the end goal to be a public company. For us, it's really about capturing the market opportunity, and that might be very well one step along the way. But I didn't found the business just to go public.
Johannes, how do you compete against OpenAI, Gemini, etc. when people start thinking about planning their trips? Isn't that going to be the first port of call? How do you compete against that kind of competition?
So I strongly believe that the experiences industry is highly fragmented and not very digitized. And most importantly, the data quality is not very good. We see that every single day. And GetYourGuide has built the best experiences layer in terms of data and engagement of a global supply base, building up a very high quality catalog. And then all of the agents on top, whether that is the GetYourGuide search in our app, more than 50% of our revenue now is going directly through the GetYourGuide app, or whether that's the open AI agent, ChatGPT just announced ads, or whether that is Google or others, they just drive incremental growth and incremental bookings. So therefore, I don't necessarily see them as competition, but it's rather complementing our ecosystem.
Okay, yeah, that's what I was going to ask you, Johannes, is how widely you define the competitive landscape. So you don't see AI tools, general AI tools, as competition for the kind of experience discovery that you're providing. Why wouldn't people just find things on a large language model and book direct?
Because typically, people underestimate how hard it is to actually come up with the plumbing and create the catalog and create the choice for customers so that they can really understand which experience they should be booking. If you look at Berlin, I'm in snowy Berlin, as you can see in the background. We have thousands and thousands of different experience creators and providers. And it is not possible for an agent to truly give you a good itinerary unless you are in direct contracts with them and capture their data. And that's exactly what GetYourGuide does. And therefore, we have a data advantage in our vertical. We have a global base of now more than 33 million people booking our experiences on a yearly basis, more than 50,000 businesses listing and optimizing their businesses. And therefore, it's natural that all of the large language providers will ultimately need to route through us and will need to go through us. And as I said, we also have a pretty strong brand and a lot of people come direct.
Do you think, Johannes, are you well positioned now, given the profitability, to make some acquisitions and consolidate in the industry? Is that something that could come to play in 2026 for you and the team?
So what we're looking at is always how we can grow the market and how we can grow our share in the market. And there's always new technologies, new entrepreneurial teams, new verticals that are being captured where we might not be as strong as in our core verticals of guided tours, attraction tickets, etc. So we'd always look at that, but we have a pretty strong organic capability. GetYourGuide has grown fully organically to more than $1 billion in revenue, and we don't see any end of sight of that growth rate. So that's really the key focus.
Johannes, thank you very much for your time. Johannes Rex, CEO and co-founder of GetYourGuide. And it is the weekend, so that sets us nicely to think about experiences that we might be participating in this weekend. And Guy, I have questions about you and what your plans are.
Do they involve any of these?
Copenhagen Fashion Week, definitely on the agenda. The Australian Open actually looks quite exciting.
That does.
Sundance, I know Anna's going to be paying attention to that one.
Excellent.
Films,
films. No, that is true. That is true. But I was actually slightly more taken by the tennis this week, given the weather was so hot. And now apparently it's the temperature is much better for tennis, so that's probably a very good thing.
We've got the Grammys.
Grammys are coming
music, movies.
Yep.
But it's sport. It's a good complementary mix this weekend.
So the Winter Olympics starts this time next week, which I'm very excited about. So I've got a week to go until that.
So we're looking through this weekend.
Yes. So I'm looking.
Bobsleigh?
Oh yeah, definitely.
Yeah.
Actually, the bobsleigh is quite exciting. Curling. There's lots of really exciting things happening. Winter Olympic stuff coming up.
Is Team Scotland still top of the list when it comes to curling?
I haven't
now
checked.
You're really testing it.
It's how you buff the ice, isn't it?
Yeah. You get obsessed with darts and you get obsessed with curling. I don't know why, but
Tom's
you do.
really probing on the detailed stuff. Right, that is it for the opening trade. The Pulse is up next. I'll be taking you through all the market response to thoughts of Kevin Warsh and where he is going next. We wait for President Trump to make that announcement. That comes Friday morning. That's today. We will be tuning in, of course, for that. The Pulse, as I say, is up next. Have a good weekend, everybody, when we get there. This is Bloomberg.